good morning, good afternoon, good evening from wherever you're joining us today for the GVF and Connectivity Business News webinar series. We're very pleased today to tackle the issue of how to access capital in 2023. First, we want to thank today's sponsors for creating online training material and supporting this initiative for the space and satellite industry and to be space qualified. These webinars and courses are a great way to onboard new staff, to broaden your general knowledge of the industry, and assume for increased responsibility and knowledge across the board. Additional information is available at spacebq.org. So with that, I'm very pleased to introduce our panelists for today's webinar. Akshay Patel, Managing Partner of PJT Partners. Akshay has been an engineer, a banker, an advisor, and has very broad spectrum understanding of all kinds of financing in the industry. Next, we have Joaquin Esplanat, CEO of QuadSat, a very innovative and forward-leaning new company that's looking to deploy drones as a way to manage RF measurements, interference isolation, and all kinds of very interesting things. Joaquin will tell us more about it. Peter Kozlowski, who is Executive Director of Strategic Planning at Iridium, the global data and voice connectivity services provider. And Noel Romolowski, Managing Director of GH Partners, who's also had a long tenure in various finance, banking, and advisory roles in the industry. So with that, let's jump right in. We're going to engage in a topical discussion, trying to tackle some issues that are relevant today. And just to set the stage, I was going to share a little bit of information about what's been going on in the first few months of 2023, which have been volatile to say the least. In terms of the venture market, we're experiencing a full reset compared to the last few years. There's been obviously challenging market forces. There's an interest rate environment that is difficult. There's general fear, concern, conservatism by investors of all classes. That's manifested itself in about a 50% drop in venture and startup financing year on year. The first quarter was in the range of 2.2 billion in new money financings. That's over 50% compared to the prior quarter, lowest rate since 2015. And total rounds for the first quarter were down about 59%. And that's just a venture. If you look more broadly at the market, capital markets, really not that active. If you look at sort of traditional source of financing, whether it's bank bond, whether it's debt, whether it's equity, quite limited. Only very, very few transactions to speak of. There is some M&A ongoing. There is still paths to raise financing, but it certainly is a very different environment than 2 years ago, 1 year ago, even 6 months ago. So with that, I think we'll jump right in. Topic number one. Just a continuation of that introduction. We've got macro terms and we have macro trends in terms of the availability of capital. We have concerns about investors maybe, quote unquote, flying to fundamentals and to quality versus perhaps something else. We're seeing some of the impact of high interest rates and some of the unavailability of capital in terms of things that are happening in the industry. Let's start with high value, sort of high, I would say, aperture views. What's going on in the market? What's happening to private and public companies? And other than sort of the obvious things, what are you seeing yourself in terms of the ability of new startups or existing startups to raise more capital? So why don't we start with you, Noel?
Sorry, was that for me?
Yes.
Yeah. So what we're saying is it's, if you think cost of capital, base rate are like the risk-free rates, treasuries, and then on top of that, credit spreads. Both we've seen kind of a lot of the financing costs, companies who are accessing debt capital much higher than it was. Really kind of you have to go in terms of rates, look back to the 90s or during kind of, financial distress periods, like the financial crisis, to see kind of the cost of capital. And things that we would have thought, wow, 8 or 9% was a high, interest rate. Now we're seeing stuff in the mid to high teens all in, as well as additional protections. And then if you think of that as less risky, debt is less risky than equity, you're seeing, equity expectations even higher. And if it's available, if equity or debt are available, seeing the deals that are getting done in the current market are for, companies that are very focused, maybe aren't cash flow positive, but have revenue, and sources of capital are, a lot of dry powder out there still, but, alternatives for capital, or investors are looking at, well, can I buy, let's say a bond in the public market that's yielding 15-20%, or do I have to do all the due diligence on a new deal? So there's a lot of competition for capital right now. I guess it's how capital markets are supposed to work. But deals are getting done, there's capital available, but a much more focus on fundamentals.
Actually, there seems to be almost sort of I would say, cross-purpose logic to this, right? Because as interest rates go up, at least in a rational market, a new class of lenders and potentially investors would typically manifest. Doesn't seem that we're seeing as much of that. Is that a sector-based issue? Is that just an overhang of the overall market, or is there other factors or forces at work here?
Yeah, I mean, I think we were seeing, frankly, probably a little bit of everything. I think foremost, the overhang is still very real. And as Noel was saying, there's been a greater focus on quality and fundamentals. So even if the capital is available, which I think we see in the market it is, there's a lot of dry powder, the bar people have to make investments is quite high. It's revenue for sure. If you're doing debt, there's got to be EBITDA, or very visible EBITDA if you're a startup company, and then you go from there. It's interesting to see that, as Noah said, there's competition for capital, but it also feels like we've got a lot more, kind of multi-strategy funds today than we have in the past. And those multi-strategy funds, the credit and the debt market is a lot more attractive for them to earn 15% to 20% returns and not take the risk on equity. And it's hard to get those investors' attention as opposed to 2 or 3 years ago when everyone was searching for growth and returns and coming to the equity side. So we are still seeing investors who are purely equity focused looking for deals, especially on the earlier side, especially those investors that raised funds in the last 2 years and they're out trying to deploy that capital. But I'd say even then, because of the overhang, the bar is pretty high as to what they're either very thematically focused on a few different areas, or they're looking for companies to have taken off some of that market and technical risk actually in this sector as well.
Now, Joaquim, you've kind of bucked the market, right? So you've had success in prior and existing rounds. We can do a deeper dive in some of the prior fundraising history, but tell us about your more recent experience. You've been able to secure an additional round. You are deploying your capital seemingly in a very efficient way, and you're having proof of concept. So tell us a little bit about how your experience has been from the fundraising side.
Yeah, I think it took longer than perhaps expected when I started, because as we started the fundraise was kind of when the market started changing. So there was at first a lot of uncertainty, but of course there was still capital available, and so there was more due diligence, more focus on business, less on maybe grand vision and when is this going to take over the world and these things, but more how is the business operating, how is the business actually working. So I think that was one of the key takeaways for me, seeing how kind of things shifted in that sense for venture capitals, that now it's much more operational, much more what are you going to be making the next couple of years, not what are you making in 5 years, 10 years time. So I think it's been good as the company. We always had focus on coming to market quite early, testing out our ideas and so on. So for us, it didn't have that profound effects since we were in market, we were generating revenue and so on. So it was still, there was still quite good opportunity to get the capital.
And Peter, Iridium is neither a startup nor is it raising money right now. But that said, we hear these retorts, fundamentals, quality. I think it'd be very helpful for the audience to hear about, Iridium's long-term focus on quality, on fundamentals, on sort of staying on mission, if you will, and how that has helped the company and what you're doing now in terms of the strategic focus of the company as you continue to grow.
Yeah, so thanks, Dara. I mean, from our perspective, we've really been able to grow and execute on our plan, which is to provide connectivity globally, right? We have a new network launched 3 years ago. We've got a variety of services, both narrowband, broadband from an L-band perspective, and then now with our recent announcement with Qualcomm on direct-to-device. So from our perspective, we really have really nice growth vectors across the board. And so really we're trying to execute. In terms of our overall kind of cash generation capabilities, I mean, that's really important for us. Being a publicly traded company, being able to reward shareholders who have been with us for a long time. And so from our perspective, having a share repurchase program, along with having a newly instituted dividend, which rewards those shareholders, has been really important. But really what underpins all of that is understanding long-term how we want to play and what our strategic focus is. So any investment that we evaluate really has to be within the lens of what does it improve in our network? Is it complementary to our network? How does it better allow us to compete as the market we see might potentially evolve? Especially as the direct-to-device trend continues. So how are we best positioned to really be able to leverage the strength of our new network as the market moves forward?
Thank you. So, I mean, I think discipline, focus, and, staying essentially, I don't want to say stay in your lane, but being very, very disciplined about what you do and how you execute. We have to talk about the topic, Silicon Valley, First Republic, contagion, even hitting places like Switzerland. Let's start with Akshay on this one. Akshay, sort of near-term and mid-term implications of what's going on with this phenomenon. Let's call it that. Obviously, SVP had some very specific and particular import for the early stage and growth stage companies. But what else can we expect in terms of impact to companies raising money, whether they're early stage or growth stage, as a result of what's going on?
Yeah, I think, this whole situation has kind of shined a light on the operational health of some of these startups. Because if you look back at what kind of kicked off, a lot of the issues at Silicon Valley Bank and now First Republic, is that they had a ton of cash come in with lots of companies raising money. And as the market went the other direction, companies started to draw down their cash at a faster rate than maybe they expected, or maybe they did expect it and were just caught on the wrong side of it. But why were companies drawing down on their cash and not raising new capital, right? That's the question. And it's, they've grown to a certain size, they're spending, and the capital is not available for them to refresh it, which is, part of the plan. You build a bit of a war chest when times are good and the capital is there. And that's what startups going to do. They're going to spend because that's what they put the capital away for. I think we got caught in this cycle. But what it does shine a light on for investors is, okay, what is the real cash burn at these companies? What's the real plan? Is that cash burn going to continually go up, or do our operators have a handle on how to scale that back if needed, or how to throttle back if needed? Does that severely impact the plan of the company, or can they survive till the next better capital market? And so I think we're seeing, as Joaquim said, the questions he got in the round he raised was about operations, and I'm sure he got the what's your monthly burn question probably as like question number 1 or 2 in every discussion. And I think that's what this is really shining a light on for the investor side of it. I think for the startups, it's a lesson learned of just another thing they've got to consider, which is don't put all your money in one place, which was probably the last thing that they were thinking about when this all went down.
Thank
Yeah,
you,
I'll-
Akshay.
I'll add to that.
Noel, I was
actually.
just going to ask you, with whatever else you're going to say, and sorry to interrupt you. You are a perpetual advisor for companies that are in early, mid-stage, and beyond growth. What are you telling your clients to the extent you can share? And obviously, anything else you want to remark on?
From that perspective is, as Akshay was saying, there's a lot more focus on how much capital you're consuming, whether it be for OpEx or CapEx in particular. They can be huge numbers. Expect that things will go slower than you anticipated. And that's just the truth about space in general. Folks a lot of times who've invested in the sector over the past couple of years haven't realized how difficult it is to, whether it's get stuff operational or just get them into space. There's so many, fault points. And so having kind of a margin of safety in your budget to deal with those. But it's really, really interesting to see how investors who came in called the 2020 to mid 2022 kind of weren't focusing so much on fundamentals, the operational expense, how quickly you're going to get to revenue, how quickly you're going to get to free cash flow. It seems like a lot of those things, and maybe it was a bit driven by access to public equity markets, being able to do SPACs, low cost capital environment. And that's really changed, and folks are back to, thinking about these things that, okay, at this valuation, am I going to get a return on investment? And our sense is there's a lot of valuations that were put on companies in 2020 to 2022 that really, if you look forward at what the real addressable market and the revenue forecasts are for these companies, probably those valuations were a bit high. And so you've definitely seen a readjustment of value. And some folks get it, some folks don't. Some folks realize that, hey, I need to get capital in the company, I'm willing to compromise. But hey, we're moving forward with our business plan and doing good things. And then there's some other folks who, still need to figure that out. And hopefully they figure it out before they run out of money.
So Joaquin, in terms of lessons learned, or perhaps some fright in terms of the contagion that's occurred, how has this experience with some of these banks informed how you're deploying capital, how you're managing your day-to-day cash burn, where you're banking? What takeaways did you and the company have?
Yeah, I think it's kind of gives this that you want to have your capital in somewhere big and reliable, and you want to make sure that that's okay. So it gives you a second thought, at least on where you have it and what you're doing with it. I think it also, to me, like debt financing, which was something that Silicon Valley Bank offered, also seemed to come. Maybe I spoke with them once, and it seemed to come off a little bit easy. Sometimes if things are too good to be true, they usually are, and so I think that's also something that's worth considering, because the trade-off maybe seems good as an entrepreneur very early, that you don't have to depart with equity. But as time goes, there is also new shareholders that's might need to come on board later, and so on, and what that means for them. So I think that's some of the key takeaways that I've had from that.
It's a bit of a dilemma in the sense, we are, and I think the market is speaking by terms of capital being moved to larger, quote unquote, perceptively safer platforms. But that said, what I think might be lost in all this is that SVB and some other banks had tailor-made programs that were oriented towards startups, towards early stage companies that really understood the need, the efficiencies of their stage. And, if that gets lost in all this, I do think there'll be an unfortunate trade-off there, because, less banks being more generic I don't think is a good thing for the industry, but that's very well where we may end up. And none of us is a crystal ball, but if anybody wants to talk to that before we move on to the next topic, I'll throw up the ball.
I will add one data point, Dark. I was talking to an early stage company just this week, and they asked me about venture debt because they had been offered actually 2 term sheets on venture debt. And, you know, very much like, so it seems like the product is still there for companies that want it. They did have some requirement to have some deposits held at that institution. You know, it was not 100% like it was being forced on before, but it was still sounded fairly high to me at, you know, something around 50-ish%. But it sounded like there's room to negotiate. So it does actually feel like the product may still be out there and maybe at better terms for the companies in terms of how much deposit they need to hold, which was a surprise to me because I would have thought, like you were thinking, Dara, that people were going to step away from it, but some people are coming in to plug the hole.
Well, nature, especially in space, hates a vacuum. So hopefully you're right.
I want to add something, and actually, your firm's probably you know, is one of the leading restructuring firms in the world. But I'll kind of say it. I don't know if you want to say it, but the truth is, with respect to companies in the sector, particularly early stage, or even companies that are producing revenue, it's a very people-intensive business. In the sense that if you lose a lot of your key people in a restructuring, you know, these companies probably will cease to operate, cease to exist. What that means is that if you do, you know, had you taken venture debt and your venture debt provider starts exerting their powers as a lender to your company, you actually probably as a company do have some leverage over them. Because without the key people, without the key engineers, you know, if a lender takes over some of these companies, they're probably not going to have much of a recovery. So kind of a going concern is probably the, and keep operating it, and it's probably the best alternative in terms of preservation of value.
Thank you for that, Noel. Just a reminder to the audience, please use the Q&A function, not the chat function. We'll get to some questions in a moment. Over to SPACs, the 4-letter word in the industry. Why don't we do it in the progression of good, bad, and ugly? Peter, I think maybe some people may not know that Iridium was midterm in its life after its near-death experience and recapitalization, started the financing for its next constellation with a SPAC. So tell us a little bit about that. Tell us a little bit about the factors that went into it and what the outcome has been for the company, which I think, you know, big surprise, was a good outcome.
Yeah, absolutely. So, I mean, I guess we're the original SPAC in the space industry back in 2008, if you can believe it. So I think from our perspective, the SPAC vehicle, the timing was right in that we had revenue. So we had, you know, a couple $100 million in revenue, a couple 100,000 subscribers. We were generating operational EBITDA. So from our profile, and maybe leaning on what Akshay and Noel said, we had the fundamentals, right? We were an actual business. We weren't pre-revenue. And so we were looking to raise capital to fund the next constellation, right? So the current constellation that we have up and running, we needed financing to fund that. And so from our perspective, you know, we had a diversified revenue stream, right? We had a single very creditworthy customer in the US government. We had a very diversified commercial revenues. We had a solid ecosystem of product development, and then partners, because we're a wholesaler, partners who would go to market. And so from our perspective, you know, we had kind of the building blocks that make a successful business, and we just used the SPAC vehicle to be able to access the public market and raise more capital. Which I think, if you contrast it with some of the recent SPAC experiences, is polar opposite, right? So from our perspective, that kind of that's kind of the building blocks of success. And if you look at the risk profile of our company, our SPAC versus the recent SPACs, I mean, I think it's way lower, right? We had the, you know, kind of proven technology, we had customers, we had earnings. So really the risk was really on the constellation refresh, as opposed to all the other blocks of building a business that had to be proven out. And so, I mean, simply put, you know, the business was there. We just needed the capital to refresh the operating network.
Noel, lessons learned, observations over the past 12 months on SPACs in terms of, you know, what was done well, what was done wrong. And I'll just try to lay a foundation here. I think, at least from the perspective we see as legal advisors in the market, it's not fair to say that every SPAC had challenges, because every SPAC involved pre-revenue companies with, highly speculative forecasts that didn't manifest, and so they're fairly getting battered by market forces. I think that's a bit unfair. So in terms of maybe framing it as neutrally as one can, what are some lessons learned?
In retrospect, it turned out to be a really, really expensive way to raise capital. I mean, if you have the fundamentals that Iridium had in 2007, 2008, when they did their de-SPAC, those seem to, in retrospect, over the past couple of years, companies with similar fundamentals tend to be the best candidates. But just as a general principle, what I'm seeing also is a lot of companies are regretting, being at an early stage in the public markets. And that sort of scrutiny that they are subject to at the developmental stage. And so there's a lot of discussion of how do we get out of this. The other point is just kind of how expensive it was. A lot of times when people are doing the transactions, they're focused on the dilution aspect of it, basically founder shares, the warrants, all that all those bells and whistles. But what also I'm seeing is, just given kind of the high level of redemptions that folks are seeing in the 90 to 99% redemptions in the trust shares, that you end up looking at, wow, wouldn't we have been better off just doing a private placement? And so I'm seeing companies that have, the gross proceeds that they've received in this kind of, some of the latest SPACs over the last year, they're paying, transaction costs in the 33 to 50% range. Whereas if they were a private company and they hired someone to raise capital for them, it would be, single digit percentages. So it was really kind of expensive, and in some ways a destruction of value of companies. But there's definitely kind of a lot of folks out there who kind of regret it. There's some folks who are high-fiving that they, resisted the urge to de-SPAC or go public for that matter. Last week at the conference, a couple companies there were pretty happy that they didn't de-SPAC.
Akshay, any perspectives from your?
Yeah, I definitely look. I think it was in generally speaking, right? This was just a tough go for the majority of folks that went through it. But I actually think it's a little bit more of a mixed bag of folks, and everyone's situation was different. And I think that's the thing to remember when you think about a SPAC or doing a SPAC. It's actually a very bespoke product, right? And it works very well in some situations like Iridium, where there was, as Peter laid out, what was there and what wasn't there and what was needed, right? It ended up working out, but you had to ignore the stock price in the beginning when it first came out, right? And so, but the need for capital there was able to be fulfilled and get things going. And I think in this case, we had a little bit of that too. I think there were probably some companies in the earlier batch of companies that SPAC that probably didn't have any other financing routes at the time. And this ended up being a way for them to bring in a couple $100 million of capital that otherwise may not have been there. Now, can they make it to the other side is a question, but at the time may have actually been the best choice. Now, there's others that I think took advantage of the market and had some fundamentals and probably could have gone the regular way IPO and not been impacted by the brand of the SPAC. But those companies aren't trading at a level where it's a broken listing now. And so they're still going to make it through, as they develop and grow into bigger companies. And then there's some that are just broken listings, and these are the companies that didn't have any fundamentals. When I say broken listings, it's like they're just trading so low that the market isn't really rational at this point anymore. Not to say that they're broken companies, right? As private companies, they may actually be doing okay, but it's a broken listing. And what we run into the market today, which I think is probably different than about 10 years ago, is that the size of these companies are too small for the market to care. So even when they have positive news or start trending in the right direction, it's going to be a long time before that's reflective in the stock price, and that's going to be painful.
Yeah, I mean, I think fairly to say there is an overall market overhang on them, and as you say, Akshay, in some of them, they don't have a broad diversity of shareholders. So it's difficult to look at the value and ascribe that as a fair or rational value or not. And I think that's certainly one factor that some of these companies are suffering through. But I think mixed bag is really a fair way to describe it. So Joaquin, we're not going to torture you through a view other than relief, regret. You might look at it in the future. What did you take away as, a bystander?
Yeah, I think you don't want to rush it, basically. So the public market is quite harsh in that way. When you go out and you don't deliver on what you say, being a startup, you might want to remodulate or go a little bit of a different direction. That's not really how the public market works.
So I'll take a quick pause to address a couple of questions. I'm going to actually try to blend them here. The first one, I'll do a true false. So there's a question as to whether real, call it heritage, established companies with revenue, are they getting unfairly perceived because they're not buzzworthy, interesting companies? So are the sort of existing companies out there, which maybe growth stage might be mature, do you agree with the statement that because they're not buzzworthy or they're not new space, they might not get the same kind of attention or the same kind of attraction for funding than if you have a company that just has sort of the killer app, or the company that is a darling because they potentially have a way to disrupt something that's not being done? Let's start with Peter.
Sorry, Dar, it's a true false.
You can say agree, disagree, true, false, whatever, however you want to address it.
It's hard to answer that one in one word. I mean, I guess you also have to say, is it current or is it past? But let's just assume current. Are we getting enough press versus the new space? I would say, I think we get our fair share of press. I would say that maybe I don't necessarily agree with that. I mean, just based on current recent news from us. So,
Joaquin?
Yeah, I think companies that are innovating, either big or small, they still get the attention, and so yeah.
Akshay?
Yeah, actually, I think I actually agree with Peter and Joaquin here today. I think in the past it was different. I think we had a lot of buzz around new space and call it pre-SPAC, and during the SPAC time there was a lot of just what's the next new best thing, because people in general from a macro perspective were chasing high risk, high growth type of assets, and people are thinking about is what's the grand vision, and is that something you want to invest in and hit this one out of the park, as opposed to the near term, going back to how Joaquin started the conversation and his experience in the funding round. So, but today, I think we're talking about everyone. I think like traditional aerospace and defense is actually performing quite well right now because of a lot of other macro trends, and they're getting a lot of press. I think the coverage of the sector today is different than it was a few years ago, where because you have kind of more press coverage, people are actually not just focused on the startups, but they're talking about the startups and the established companies, and comparing and contrasting them and reporting on both. So I think it's very different today than it was 4 or 5 years ago, and it probably encompasses everyone.
Thank you, Akshay. Noel?
I forget how to answer it, yes or no, but I will give an answer that I think kind of looks at the data. And I'm not saying this to flatter Peter because he's on the call. But if you look at, let's say, the kind of Iridium, you've been around 25 years, you're kind of almost old space now. But that being said, Iridium trades at a multiple much higher than, let's say, the legacy geo operators, and that is focused on profitability and growth. Whereas the traditional geo operators are trading at, probably half the multiple of Iridium. And so if you kind of look at it, investors at the end of the day figure it out. Short term, there are a lot of dislocations on value, and focus on companies that have, good buzzwords. They're going to be, use words like disruptive. But at the end of the day, the capital markets figure it out, and they see where growth is. Those companies will trade at higher valuations than those companies that may be in secular decline. Classic geo operator issue is the historic dependence on video revenue, and just not, demanding as much video over satellites as we used to, given, the advent of streaming and other factors.
Thank you, Noel. Next topic, Virgin Orbit. Once, not so far ago, a high-flying, high-ceiling business. Now under US bankruptcy protection. Is it portending? Is it sort of the first shoe to drop in this market? Is it more of an isolated case? Are we looking at specific issues, timing, fundamentals in terms of cash needs versus cash burn? Welcome the group's views as to sort of the why and the what. And more importantly, is this really portending more of the same going forward, given the macro market? Why don't we start with Akshay on this one?
Yeah, I mean, look, I think with all things, there's probably a bunch of different things at work here. I think the point I would probably make, and there's probably many more to make, is that, there's patient capital, but it's not unlimited patience, right? And so I think this is a situation where I'm sure there's many things going on, but in the end, it was too much delay, too much time to get off the ground in a consistent manner, and your very long-term patient capital, ran out of patience. Now, is there more around that? I don't know, but I think as a general takeaway for companies in the sector, at some point, your investors are going to run out of patience, even those that you think have, a lot of capital behind them.
Noel?
Yeah, I mean, there's in one sense, you look at it and say, wow, what Virgin Orbit is doing, there's, the world needs a capability like they are delivering. On the other hand, is the need to, a huge amount of capital has gone into the company. As Akshay says, it's, results have been delayed. But, is there what they're doing as demand? Is there a demand that people will pay for, whether it be governments around the world or commercial customers, to justify at least kind of what they were doing previously? Hey, hopefully, bankruptcy is a way to refresh, focus the business, and just given their, the market that they can serve and the potential revenue from that and profitability, resize the company.
Peter, any thoughts as, a company who some time ago went through something like this?
Yeah, I mean, I think it does point to the general fundamentals, but then more so, I mean, the technical risks, right? I mean, and then executing is just really hard, right? So, I mean, I know everyone kind of talks about that, but I mean, it's really challenging, right? And I think from where they were, I mean, the capital required, the technical leaps that have to happen, and then all under the timing, right? The strict timing of them being a publicly traded company. I mean, I think it's a really challenging mix. So I think maybe through the bankruptcy process, they can prioritize things, see what works, what might work. Hopefully talent stays, and then they're able to generate a path forward that kind of gets them to some sort of revenue relatively soonish. But I think from that perspective, I mean, it's gonna be challenging. It's gonna be a tough road.
So Joaquin, pulling the thread a little bit on what Akshay and Noel shared, you're living it now, proof of concept, defining a market, demonstrating the value in your services. Tell us a little bit about sort of how much you're focusing on that and what you're doing to make sure that the investors understand where you stand, where your potential is, what your market looks like, and how you're executing.
Yeah, we're spending a lot of time on doing these things, not just for investors, but for ourselves as well, to know kind of where we need to take the company. I think that ultimately actions is louder than words, especially when you're so new into the market, that it's really about getting those proof points and showing that, and showing how that can be replicated in different organizations or different industries and so on. So but I think it is really important that you actually show it and do it. That kind of makes the whole difference for investors and also for your own team as well, to show that it is working. So I think that's really the key to being a startup, is that execution part of it.
And if you're willing to share with us, I mean, you've done a few financing rounds, Akshay, I think, alluded to it.
Yeah.
What were the issues or questions that you had to repeatedly address with your early stage investors? Because, while you are obviously in this industry, your solution is a little bit more, I would say, forward looking, a little bit more creative. You're combining different kinds of technologies. And how did you convince your investors the need, the market, the opportunity?
Yeah, so I think that changed. Did that
And by the
change
way,
along the
Joaquin, to
journey?
interrupt, maybe 30 seconds on what you do, because I don't want to presume the entire audience understands that.
Yeah. Okay. Yeah. So basically, what Quadset do is we develop a technology that uses drones to test and measure the radio spectrum. So this is often, I used to work myself in the oil and gas sector, where we had to take whole ships out of port, sail them around to make sure the antenna on the ship could work. So basically, instead of sailing a ship around the antenna, the value proposition was, let's fly the satellite or drone around the ship. So basically, we develop a unique radio payload that you can stick on any drone, and then we combine that with a software that plans out autonomous flight and then analytics of the data. So as we started out our first fundraise, it was really a lot about basically showing that you as a founder are capable of taking many different, looking at the market, looking at the technology, and getting interest from the market. So we started out with some early interest from SES and some of the major satellite operators, and that of course gain a lot of value to or credibility to a startup in Denmark, to show that we had gotten that type of interest. Once we grew a little bit further, we moved away from angel investors into venture capital, and then it became more important with what kind of projects do we have, what kind of even grant funding are we being able to demonstrate, and so on. So it kind of increases in the demands from the investors, but quite gradually, alongside on what you should know as an entrepreneur as well. So in some cases, it can be quite good to go through a fundraising round, because it goes, oh, I'm a little bit weak here, and then then you dive into it, and you strengthen that up, and you kind of balance that out. So coming out of a funding round, you also have stress tested your own strategy, you stress tested the market, so you know a little bit better where you need to go and what is the next things you need to do. But also getting other people on board with the idea and the company is helpful. So we tried to get companies that were, so we have Seraphim Capital as one of our investors, and they are of course space market focused. That made it a lot easier for the Danish state to come on board, because then they could trust a little bit, not just in what I'm saying, but also in what Seraphim was saying about the market and how it's going. So which was maybe difficult for the venture arm of the Danish state to grasp in full. So it's about being a little bit strategic in that way as well.
Thank you for that. Now, I think you've very nicely prepared us for something else to talk about, which is in terms of sort of this perceived progression of capital raising for early stage companies, which typically it's, founder or friends and family initial investment, then you get to angel, you get to seeds, then you go to ABC, and then eventually maybe a sale, maybe debt, maybe IPO. Some companies are not following that roadmap, and some companies sort of go sideways, or they skip, or they mix and match. Would love to hear perspectives from the panel as to what kind of factors will inform a company that's raising financing to follow the well-worn path or to decide that they're going to do something different? Is it the technical evolution? Is it the market? Is it being opportunistic? So we very much would appreciate some inputs. And Noel, let's start with you.
Yeah, from that perspective, I think kind of do things that de-risk your business plan. And, so for example, let's say you're a hardware manufacturer and you're going to put something in space, or a component that goes in space or a spacecraft. What can you do to accelerate that huge milestone? And, people talk about this milestone, but it's a huge, de-risking if your product is put in space and it works in space. Also think about, strategic partners and how they could, and that's actually something, and folks to think about is, there's a lot of folks who are doing something that's adjacent, and maybe you could be helpful to de-risk their business plans or their aspirations of areas they want to go into by your product. So think about strategic alignment. That's a way to maybe, get from, let's say, seed financing to venture financing to, let's say, further de-risking and being able to attract that later stage capital, which tends to be cheaper than the kind of normal progression. Sorry. But that's kind of the point, is if you can de-risk it, you can maybe jump some of these things, particularly get to strategic financing.
Right.
There's one other point is kind of, I learned this early in my career, which was the IPO route. Show to, early stage companies, show that some big company will want to buy you in the future once you prove what you're doing and gain scale. The idea that you'll have an IPO exit for a lot of investors is something, IPO markets are hot. I don't know, I'd say once every 20 years. So if you're getting funding now, and we just went through this huge IPO SPAC public markets exit scenario, focus on now, okay, some big company will be a strategic exit. I'm seeing a lot of investors now are, thinking about when they invest in a company, is there going to be an exit to a strategic at some point? So that's another way to people should think about it.
Thank you. So Akshay, there's obviously pros and cons, and perhaps some of the companies that participate in de-SPACing were just simply taking advantage of market forces and skipping some steps. But love to hear your perspectives on this.
Yeah, no, definitely. And in this sector in particular, it's especially interesting. I think the perennial issue has always been, how do you get from, call it your Series B to your Series C? Because I think that is where kind of the investor requirements really change in terms of the progress of the company. And in this sector in particular, I think it does go back to, founders, management teams thinking about what is the actual capital required for us to take technical risk and commercial risk off the table, so that we can go to these investors in our Series C round and actually raise the amount of capital required to scale. And if that number is, 40 to 50 million, then I think there's venture capital money out there with seed A and B rounds to do that and get you through that point. If it's greater than that, then you got to start planning for scenarios where, like you said, you got to go sideways a little bit. And there's a couple different ways to do it, right? If you think you have a plan that can attract some, frankly, large high net worth individual or family office to put in a, call it $50 to $100 million check in your B round, like some companies have, that is a path that gets you to where you need to go and take that risk off the table. In the US in particular, right, we've had participation from AFWorks and the StratFi program to help bring non-dilutive funding to companies in this sector, which I think has also helped bridge people from, raising 40 to 50 million in those first two rounds and getting, matching funds up to 60 million to really get to the next step. But if you're thinking about that at the point of you raising your Series B, it's probably too late. So that, I think that's the thing to remember is, put yourself in the investor's shoes. What do they require? Think ahead. And if your plan doesn't really fit those, then you got to start thinking of what those alternatives are. And the sooner you think about it, the better, the better chance you have of.
So Peter, historically, let's call it the new Iridium, has hit its marks in terms of the financing sources it's used, with remarkable timing and precision, right? Whether it was the SPAC, whether it was the ECA financing for Next, converting that into a term loan, and then looking at other options. Other than being good and lucky, do you attribute anything else to the wisdom behind those decisions?
I think it was good and lucky is a great way to define it, Dara. I also think, you know, the extent to which the evaluation of the different forms of funding, right? So if you look at the build out of the constellation, I mean, the export credit facility was really, you know, there weren't terribly very many options for us to partake, and so that was one which was really beneficial for us at a critical time, right? So from that perspective, that was you know, a great program to participate in. I think the conversion to Term Loan B, that was something that really allowed us a lot of flexibility as a company to then be able to pursue additional growth, and really better suit us as a publicly traded company. So from that perspective, that was also just, what can we do? And thankfully the market was where it was, so we were able to refinance or finance out of the credit facility into a Term Loan B. So from that perspective, I mean, I think there's a lot of avenues of capital depending on the maturity and where you are kind of in the corporate life cycle. So I think from our perspective, we've kind of been through it all, and you know, there's pros and cons to each of those, and I think it definitely obviously depends on kind of what Noel was saying earlier. It depends on what the market is, what the trends are in the market, and how can you best kind of align where you are in your company life cycle to what's happening in the market to get the most advantageous terms at the time.
Thank you. So, Joaquin, I'm going to layer on one other topic, but obviously, please feel free to answer any part of that. For now, better part of a decade, we've seen in terms of strategics, them establishing their own independent or quasi-independent investment vehicles. So, you know, Lockheed Martin Ventures, Airbus Ventures, Boeing had Horizons X, and it actually transferred it to another entity. How do you see that as a source of financing in the market? Is it useful? Is coopetition, if that can be a word, with some strategics a useful force? Is it a way to maybe grow your addressable market? Is it a way to have an exit to strategic? Or is it nefarious because, you know, the bigger, you know, company can guppy you up? Or maybe all of it?
Yeah, I think it is definitely all of it, right? But it's a lot to think about as a startup, and as early as possible. You know, the clearer you know where you're going, the more you can fit that piece into the puzzle, and work around that, and work it to your benefit as a startup. But there are also some uncertainties of, okay, so what impact do they have on a strategic level, and what happens down the road if things doesn't go exactly as planned, you know, and these kind of things. So there's certainly something to look at there as well. But honestly, I think it's really positive that they're coming in and growing and increasing their presence, because it makes that barrier between the startups and the corporates much smaller, right? It's easier to engage with them. They have a way in for you, and maybe they might not always be interested in investing either, but certainly if you're an innovative company and you meet and you meet someone from their innovation department, then it's easier for them to also help guide you in the right direction, because it can be really hard to find the right person to talk about antenna measurement in Lockheed Martin, for example. That's he's not at the booth at the satellite show, that's for sure.
So actually, having been somebody who actually built satellites, now in your role as an advisor, if you have a startup company that you're advising and they get a cold call from either a strategic or from the venture arm of a strategic, what are the top 2 or 3 pieces of advice you give them up front?
Yeah, no, I think it's look, so one is you definitely take the call. right? Because
Mhm.
there's capital available and you want to be looking at every source of capital, right? I think two is you've got to have a clear understanding as, you know, the operator, you know, what you want to get out of that relationship. And the more clear you are about that upfront, the better this will go. That being said, you know, I think each of these companies have taken a different approach as to how they do this investing. And I think that the trend is moving towards really separating it from kind of the core, call it M&A and operations of the corporate, and really making it more an investment vehicle that lets the corporate have exposure without, you know, being tagged as, you know, we're going to take this over, which I think the corporates are realizing, you know, in some cases, and probably in many cases, the further they keep the company away from some of their traditional folks at the company is usually better, because historically these companies have not done a good job of incubating innovation from other companies. And take it from someone who I would say I'm probably the leading edge of a young engineer, and there's a whole generation after me that came that has really, you know, expanded on that and innovated and started companies on their own. But there's a huge gap between, you know, say someone my age and people who are working at these companies for, you know, 20, 30 years. And I think we may end up in a place here and where it's a lot like biopharma, where these large aerospace companies are no longer doing, you know, really deep tech R&D and innovation, and it's being put on startups where you've got a lot of young talent coming out of a lot of other companies, and the companies that figure out how to work that relationship to the max and not interfere with it are going to be the ones that benefit. So it'll be interesting to see the next 10, 20 years, because we're hitting that point where, you know, that talent is leaving the large companies and the young talent isn't joining. And so where do you go for R&D?
And you could argue we're already seeing that manifest in certain industries and countries, frankly. So it's an amazing shift in terms of knowledge base and talent and prospect. Noel, any views on that?
Yeah, no, those are great points. And, you know, to the extent you're speaking with a corporate venturing arm, make sure what you're doing is, you know, don't think of them as just, you know, cash. Think of them as, you know, why would they invest in you that's relevant? And then kind of the other side, as Akshay was saying, is they have a lot of talent, you know, that could help you de-risk your business plan. So I think of companies that, you know, Lockheed's, Airbus, Boeing's, they have a ton of engineers who know how to do assembly, integration, and testing. So whether you're an operator or making a component or a new satellite, there's a lot of talent in those companies who could, you know, have learned a lot over the years, who could help you not make those same mistakes. So that's actually one of the great ways of it being mutually beneficial. And most of these companies are sensitive that they don't want to be viewed as you know, incubating and then eventually taking over the company. They're open to other partners. But a key thing in approaching them is don't think of them just as money. Think of it as how you're relevant to other things that they're doing. And I think kind of using case studies around the SDA program and companies who've gotten money from these partners and how that's helped some of these big folks be relevant to the Space Development Agency program. There's one other point, actually, you know, Peter, Iridium was big beneficiary of BPI France, the French Export Credit Agency. A trend I anticipate is just given whether it's lack of availability of debt financing, or, you know, huge financing that you need. I think the ECAs over the next couple of years are going to play a significant role in financing projects. Now, they're, you know, they don't take a lot of risk. They don't take, as Akshay was saying, wanting to take technical or commercial risk. But it is a very attractive source of capital, both in terms of not just because it's potentially lower cost than commercial financing, but the duration of financing. So, I mean, a lot of the things done in the sector are long-lived assets. A lot of commercial providers of debt financing have really short time horizons and don't know how to, let's say, for example, in a satellite operator, deal with the construction period, and then you have something that lasts 5 to 10 years thereafter. So ECA financing will be, I think, an attractive source of capital here in the US with the Export-Import Bank, and in Europe with folks like BPI France, in Canada with EDC. So each country has those, and depending on what country you're in, I'm sure Denmark has one too. But that is going to be, in a kind of this dislocation we're having in the current environment, the ECAs will play a significant role in particularly some of the bigger projects.
Yeah, maybe I'm going to pull the thread a little bit and maybe ask Akshay, Peter, and others to share their thoughts. There are significant, obviously, macro forces that lead to ECA financing becoming much more attractive. There's also a level of rigor and a level of patience one must have to get through an ECA financing, as well as making sure that the project hits a lot of check marks, in terms of, does it have a developmental focus? What benefits does it have? Does it have the right amount of content from certain sources, especially if you're doing a club deal, a multi-ECA deal, which, many in the space industry have done. So Akshay, maybe, some pros and cons, as well as your views as to whether that ECA source of financing is going to become a little bit more tapped over the next couple of years.
Yeah, I mean, look, the pro is the rate, right? I mean, you're basically getting, in some ways, a subsidized rate. Now you can argue against that you've got to jump through so many other hoops in terms of showing things that may require you to sign up some contracts that you otherwise wouldn't have signed up just to show contracted revenue to get your ECA financing through, and so that increases the cost. But with the right motivated partner, it should come in less than what you would do in kind of the market for higher risk debt financing. I think the biggest con, honestly, for this industry though, is just the time that it takes, right? So if you're not thinking about it from the get-go, right, and knowing that it's going to be a 12 to 18 month long process, maybe more, it's just not an option for you to go down, right? If you haven't thought about it soon enough and you need the capital sooner. So that to me is the biggest issue. And I think in today's times, what we're seeing in terms of constellations going up and being smaller and going up faster, it actually may not make sense for a lot of these folks because of just the time it takes to get through.
Thank you. I don't know, Peter, Hakim, if you want to share some views in terms of, I know, Peter, it's quite a retrospective look from your perspective, but a very successful one.
Yeah, maybe just briefly, I mean, I'll echo some of Akshay's points, but I mean, from our take, it obviously was very beneficial. There was a lot of rigor. And I do think the profile of a company who decides to use this financing, there's a certain profile, right? You kind of have to have, because of the timing and the rigor involved, you kind of have to be slightly mature in that you have to have some sort of revenue. You have to have some sort of, operational cash flow. And so I think if you're an early stage startup that has kind of a quick timeline, I mean, I think it'll be very, very challenging to try to get through that. So again, I mean, it's kind of unique in our circumstance. We obviously benefited, I think, a lot from it. It was rigorous, and it did provide, very specific stipulations on what we could do even after we built had the constellation up and running. And so from that perspective, I mean, it was useful at the time, and I think it's a good option depending on the profile of the company if you need capital, but know what you're getting into. So that's the quick summary.
And I'll just add before we go to Joaquin, I think for the audience, you don't necessarily have to tap an ECA source of financing for your entire project. It can be a form of complementary financing. So if you have already financing for an aspect of your project, but let's say you want to finance your launch services or your terrestrial segment or something else via ECA, particularly if you're in the midst of a procurement and the content for that procurement, satisfies your need and sort of the affiliation between country and exporter all work out, you can do part of it. You don't have to do all of it. But I do think it largely speaks to the right tool for the right time for each company. And I think that's what we're hearing across the board from all the speakers. different financing sources and tools, different pros and cons. And I think each company raising money just needs to take that into account, make sure you're using the best tool you have at your disposal at the right time. So I don't know if that sets you up or not, Joaquin, but any views you may have would be welcome.
Yeah, I think, you know, there's a lot of different tools, and you know, ECA financing is another tool in the toolbox. For our sake, it's not something that we've considered very much so far. Maybe a little bit further down the line, but maybe need to be early out there, as I hear it can take some time.
Thank you. So I'll end it with a question. It's actually much better directed to economists, but I'll give everybody a shot if you want to try to take it on, which is essentially, what needs to happen for the markets to improve to ease? Is it lower rates? Is it something else? So what do we need to see? And I think maybe I'll filter it a little bit. What do we need to see on a macro level to get to a more rational market in terms of the balance of financing sources? Why don't we start with Akshay on that one?
Yeah, look, I mean, obviously none of us have a crystal ball. I think things that would help, right? Look, there may be a world here where we're not going to return to a very low interest rate environment, right? And if that's the case, then I think the market needs to rationalize in terms of the good companies with fundamentals continuing to go on, and the companies that need to take strategic action, take those strategic actions, and the market rationalizes and supply and demand get back into place. So we may be in for that type of adjustment before things get better. But we could also, some other geopolitical or macroeconomic action could happen that none of us could predict, and we're back to lower interest rates and free money, and things start going the other direction again. So it's hard to tell. We've seen it before, but if it's not a shock to the system, people should be prepared for that type of kind of longer term rationalization.
Peter, you want to throw on your economist hat for a second?
Yeah, I mean, listen, I think from my perspective, some of the rigor that we've seen flow through the markets is good, right? So the higher cost of capital, I think, the zero interest rate policies created, I think, a lot of excess. And I think now you've definitely are seeing more rigor, a lot more focus on fundamentals, which I think in general is good, right? I mean, it weeds away some of the things that, obviously were a bit too aggressive, a bit too optimistic, and really focuses on what do we think is possible. So I think from my perspective, I think obviously we'll see what the central banks do, and hopefully no additional kind of crises through the banking system. But I do think there's the rigor is kind of necessary after a couple of years of excess.
Noel?
I'll take off my economist hat and say take a policy approach, which is or political approach, which is we've seen all the impacts and things as everybody else has spoken about on the call, from interest rates, inflation, all those things, supply chain, those will normalize over time. But more significantly in the short term, politicians, please stop fighting and resolve the debt ceiling crisis. If you look back to last time we were in this situation, 2012, and what that did to capital markets, cost of funding for companies, downgrading of U.S. Credit rating. Let's just get along and get something resolved here, move forward. Spend less might be a good thing too. So unfortunately, we're a little bit subject to what goes on down in DC. So if you could resolve that, I know you're in DC, Dara, if you could resolve that for us, we'd be most appreciative.
We'll do our best. There are some structural impediments, but yes, we'll do our best. Joaquin, any views from your end?
Yeah, it's hard to say. Sit and wait a bit and see what happens. But yeah, I guess with time things will hopefully normalize a little bit, and then we can work hard and innovate and bring new technologies.
So thank you. This brings us to the conclusion of the webinar. Akshay, Joaquim, Peter, Noel, thank you very much. And again, Dara Penny here of Millbank as the moderator. I want to just point out a couple things before we conclude. One, you can watch the recording of this and prior webinars at gvf.org. And please join us for the next event, Connecting Antennas and Satellites, a Critical Link, ? 25 May, same time, 3 p.m. UK, 10 a.m. Eastern, and look forward to connecting with the audience then. Thank you, GVF. Thank you, speakers. Wishing everybody a good day, good evening, good night, wherever you are.